If you've been lazy about your mortgage, you're essentially paying a procrastination tax to the bank and could be potentially missing out on $15,000 in the next 3 years. Let's talk about this today. You've been watching the news and hearing that interest rates are finally dropping, and if you are stuck deciding between a floating SORA rate or a fixed rate or a HDB loan, then this video is for you. This isn't just for private property owners, it's for every single property owner in Singapore, HDB or private, watching your monthly installments eat away at your wealth. And it's not just about the rate, it's about your loan to value or LTV and your loan size that decides the deal you're getting. In 2026, the playing field is level. Since August 2024, HDB LTV limits were tightened to 75%, matching bank limits for private properties. But here is the paradox. In this market, sometimes the more you borrow, the less you pay. Banks are hungry for your business. As an example, a 950,000 loan may get you a 1.5% interest rate, but stretching it beyond 1 million, for an example 1.1 million, can potentially unlock better rates. I'm going to show you why taking a larger loan is the smarter wealth move that you can make this year. We are talking about a potential $15,000 net gain in just 3 years by just understanding the bank's own rules. Today, we break down the double whammy effect and the math of interest rates. Why is 2026 the year of interest rate flip? Look at the Trump effect. With Donald Trump in the White House and Jerome Powell's term as Fed chair and this May, the market is pricing in a massive shift. President Trump is vocally pro-low interest rates, and his next likely Fed chair nominee would also want to keep the economy hot. This 1.5% interest rate environment is a multi-year cycle for at least another 3 years till the end of his presidency term. And locally, banks like DBS, UOB or OCBC are offering 3-year fixed rates at 1.5%. Take note that this isn't the banks being nice. If they lock you in at 1.5% for 3 years, it's because they believe that the floating SORA rates are heading for even lower rates. They want to capture your loan quantum at a higher interest rate before the market bottoms out. And to understand the bottom, you have to understand SORA. Unlike the old SIBOR, which is based on future guesstimates, SORA is the truth benchmark. It's the average of actual borrowing transactions in Singapore's unsecured overnight interbank rates, published and regulated by the Monetary Authority of Singapore or MAS. Because it is backward looking, it creates a predictable path referencing events that are happening currently. As the Feds cut interest rates, your mortgage follows with a 3-month lag. And usually falling interest rates means a struggling economy, but we are doing this while our economy is booming. Closing 2025 with a massive 4.8% GDP growth. In 2026, we have high growth fueled by low interest rates. Meaning, as of now, referencing the internal and external macroeconomic factors, a floating SORA rate may turn out to be lower than the fixed bank rates in the coming months or years. But why refinance now? Let's take a look at some of the numbers. For a 950,000 loan over 30 years at a 2.5% interest rate, your monthly mortgage is $3,754, which means $1,938 or 52% goes to interest and $1,816 or 48% goes to principal. You are in fact paying more to the bank than your own principal amount. Now let's take a look at the 1.5% interest rates breakdown. Firstly, your monthly mortgage drops down to $3,279, which means $1,159 or 35% goes towards interest, and the remaining $2,120 or 65% goes to principal. Even though you pay $475 less every month, you are paying $300 more into your own principal. By delaying now, you are essentially paying a $775 procrastination tax every single month to the bank. Most Singaporeans are asset rich but cash poor. If you have a $2 million condo fully paid up but only $20,000 in your bank, you aren't secure. You can't sell part of your property, neither can you eat your walls in the case of an emergency. When you pay down a 1.5% mortgage with cash, you are only earning that 1.5% on the money. That is a massive opportunity cost. You are choosing the feeling of safety over the reality of wealth. Even in a higher interest rate environment, if it's 2.5% or 3% depending on your external investment vehicles, it might actually make more sense for you to take the bigger loan if you know what you're doing. This is why our dear friend Robert Kiyosaki once said that real estate is good debt. Let's take a look at a 3-year example now. Neighbor A, 950,000 loan, 30 years loan tenure, 1.5% interest, results results in a 3,279 mortgage, 2,120 principal versus 1,159 in interest with no extra cash on hand. And now we look at neighbor B taking a slightly bigger loan at 1.1 million, 30 years loan tenure, slightly lower interest rate at 1.4%, results in a 3,744 mortgage, $2,492 goes to principal, and the remaining 1,252 goes to interest. He has $150,000 cash on hand because he didn't pay down his loan. And the difference in mortgage is $465. Breaking it down, difference in principal is $372 and difference in interest is $93 every month. For 3 years, neighbor B pays an additional $3,348 more in interest, but that spare $150,000 cash on hand, if invested in a 4% investment vehicle, earns an extra $18,729. Now immediately I can hear some of you saying, but ASAP, if I take a bigger loan, then my monthly mortgage is higher, I have less cash to spend every month. And you are 100% correct. In our example, neighbor B has a higher monthly mortgage of $3,744, whereas neighbor A's monthly mortgage is $3,279. Over 3 years, that's about $16,740 in extra payments you will have to make. But don't forget that in a higher mortgage, it also means that you're contributing more back to your principal anyway. And also out of that $16,740 extra that you're paying, $13,392 goes back to your principal and $3,348 goes into the interest, which was the extra interest we were tabulating earlier. The real cost here is the difference between the interest rates. Thanks to taking a bigger loan, you get to keep more of your money liquid, $150,000 in this example, and get a slightly lower interest rate. So if you run these numbers down for the two situations over 3 years, this is what their final numbers would look like. The $950,000 loan becomes an $873,049 with an extra cash flow of $16,740 from getting the $465 every month. The 1.1 million loan becomes slightly above 1 million, right, at $1,009,592 with an extra cash flow of $150,000 and getting an investment return of $18,000 at the cost of paying an extra $3,348 in interest. And now after President Trump steps down, if interest rates do rise after the next 3 years, neighbor B still has the flexibility to lower his overall principal by dumping all of the $150,000 and investment returns, and then his loan can be reduced down to $840,000, which is still lower than neighbor A's $873,000 balance. The key lesson here is to take advantage of lower interest rates to perhaps allow for greater liquidity as insurance against potential life changes. For neighbor B, because he took the bigger loan and kept the $150,000 liquid, even if he used that $150,000 to subsidize his own mortgage by paying an extra $465 every month, at the end of 3 years without investing at all, he would still have $133,000 left in his pocket. For neighbor A, where he took the smaller loan to save extra $465 every month, he has $0 in extra capital, less the money he saved. And if it's a question of investing $150,000 from the start versus $465 a month for 3 years, the larger amount would definitely earn better returns. At the end of 3 years, the one with the larger loan amount in the low interest rate environment still wins at the end of the day. So yes, by paying down your mortgage, you will have better monthly cash flow, but you will have zero financial liquidity and flexibility. If you lose your job in 2026, neighbor B with 1.1 million loan and $150,000 in cash can survive for years. Neighbor A with a smaller loan amount and no cash on hand is in trouble the very next month. This is why this isn't just a wealth strategy, it's an insurance policy. So let's put it all together in a formula that you can use for your own home loan and perhaps a little interactive segment. You will have to find out 3 things. Number 1, the loan gap. Number 2, interest penalty or cost. And number 3, the investment yield or gain. Using the scenario we spoke of, the loan gap was $150,000, 1.1 million versus $950,000. The interest penalty or cost over 3 years was $3,348, and the investment yield or gain was $150,000 in a 4% investment vehicle for 3 years, which results into over $18,000. Using your loan gap, you can derive your interest penalty and investment gains. And to find out your net profit, take the gains minus the cost, which in this case is $18,729 minus $3,348. You will get $15,377 as your net profits. And I would like to call this $15,000 your efficiency profit. You didn't work a single extra hour for that money. You just simply chose not to bury that $150,000 into your home and decided to leverage on the low interest rate to earn more elsewhere. And so after you account for the slightly higher monthly payment, you will still be at least $15,000 ahead in your net worth. You are essentially getting paid $5,000 a year just for having the courage to manage your own money. But as you play around with your own numbers using this formula, you will have to adhere to 3 rules of thumb for 2026. Rule number 1, opt for SORA packages that grant you flexibility. This means that it allows you to convert to fixed rates if things take a turn for the worse later on in the year. Rule number 2, check for the interest tier for each sum is usually different for above 300,000 or 500,000 or 800,000 or $1 million depending on each bank's policies. And if you're a premium member, this certainly helps to lower your overall interest rate. And rule number 3, only use this strategy if your loan gap is the amount of money you're planning to invest. If you're going to spend the extra $150,000 on a new car or fancy decorations or luxury renovations, just don't do it. You're just taking in more debt. This formula is for wealth building and not lifestyle inflation. And just to touch on the HDB loan for a bit, we all know that HDB loan is fixed at a 2.6% interest. And even though it seems relatively high now, you have to understand the characteristics of a HDB loan. HDB loans require no attention at all, meaning that it's a fixed 2.6% interest for the full 25 years loan tenure. You won't have to worry about rates going up or down, repricing or refinancing. HDB is also not as heartless as the banks. For banks, when you miss a few, maybe 3 monthly consecutive payments, they can move to foreclose your house. However, think of HDB like that nice motherly figure that will tell you to take care, pick yourself up again and repay back whenever you can. They won't immediately start chasing you for money. They are often way more understanding than banks and generally won't repossess your house unless you've missed payments for potentially years and made no effort in repayment at all. So if you want a peace of mind and that psychological support that you won't be left stranded on the streets should things take a turn for the worse in your life, then HDB might be your best bet. But if you want to capitalize on market movements, maximize your wealth, and you possess enough financial support and knowledge of what you're doing, then bank loans in this period might be your best bet. And so in summary, current macro factors and banks are signaling towards lower interest rates, possibly at the COVID levels once again. These lower interest rates will likely stay or go even lower thanks to the US president and the upcoming Fed chairman changes. And because of that, SORA is likely to perform better than fixed rates as long as the situation remains the same. It may be a good time to consider refinancing and leverage your returns in more profitable portfolios at your comfort level. Take on flexible loan packages so that you have the flexibility when things take a turn for the worse. These packages should allow you to convert to fixed rates after a year or so. Use this to free up more cash in hand and you will not have to worry about your mortgage in a scenario where circumstances change. And lastly, invest the extra cash and don't use it to inflate your lifestyle. And so that's it. If you want to discuss more about how you can maximize your wealth or need assistance or clarifications in the calculations or simply do not know where to start, feel free to drop me a text at 9697 1000. I'm ASAP and I will see you in the next video.